keep you up to date with current market news and teachings and everything tech. So today I'm going to be going over some interesting things that I've been seeing in the market. Is a little bit scary, right? So we go back to the whole '08, 07, '08 financial market crisis. Where did it originate? Originate in derivatives, right? These complex investment vehicles that these banks put together and just sell them to anyone, like institutions. And sometimes they create these complex derivatives that get around regulations, right? Because, for example, pension funds, mutual funds, and so forth and so on have to meet certain strict guidelines in terms of the vehicles they're investing in. But these banks create these complex, intricate derivatives that pretty much allows it to seem like they're safer than they are. And then it opens it to certain institutions that otherwise would have not been able to invest in those kinds of vehicles due to regulations, right? So some really sketchy stuff happens in the derivative markets. The interesting part of the derivative markets is that its market size is literally larger than the global economy. Just put that to thought for a second. These dangerous investments are literally larger than the global market. I mean, Warren Buffett literally is quoted calling them financial weapons of mass destruction. I mean, that's literally what Warren Buffett calls them. But right here, I'm just going to start off with a quick couple of technicals because this is pretty much the AI ATF, right? I call this the SOXX, which is the semiconductor ETF. Pretty much has NVIDIA, all the big semiconductor companies that have made big money or profited in terms of investors jumping into their equities, right? But here I'm just looking at the charts and it's the most beautiful head and shoulder pattern I have seen, which is a bearish pattern, right? It typically means, hey, this might potentially decline at some point in the future, right? So I've been looking at this one for a bit, but it's a pretty bearish pattern, but that is a beautiful head and shoulders pattern there, which typically with probabilities leads to a decline in the future. Not always, because these technicals are not always right? But that's interesting. And then here I'm seeing, right, a divergence in the volume too. As you can see, it's been going up, yet the volume has been going down, which happens pretty recently. Back in August, it had a pretty big rally. As it was rallying, however, the volume, as you can see, these little green bars here, were declining, and then it had a bit of a sell-off. So I'm pretty certain that this might potentially sell off in the near future. So what I wanted to talk about, I just wanted to say that because I'm pretty bearish in the markets, the American markets specifically. I've been making some videos talking about China and so forth, and then bullish on them, which a lot of their ETFs have done pretty amazing as of recent. But what I'm going to be talking about is derivatives, right? And an interesting fact is that this correlates with the Fed, right? Because the Fed bails out the banks. The banks are the market makers for the derivatives, right? Which a lot of them are traded over the counter, right? OTC, which means they're not being reported, right? This is like a sketchy, hidden, secret market that these major institutions traded. But here, this is interesting to see because this is telling me that the Fed is freaking broke. The Federal Reserve of the United States is broke, literally. This kind of shows, because what the Fed does, right? When there's a crisis, they borrow money from Treasury, and they inject it into the system to save it from a financial crisis, right? That's what they did in 2008, what they always do, going all the way back to the 1930s, right? But here what we can see is that the Federal Reserve owes Treasury a ton of money. This is insane how much money the Federal Reserve owes to Treasury, right? And who is Treasury? Treasury, right? The Treasury Department has a money printer and so forth and prints money. However, where does that money come from? The taxpayer, right? So that means that the taxpayer is going to have to pay all this money that the Federal Reserve is deep in owing Treasury. So that ultimately falls on the taxpayer's back. And this is interesting because it's kind of similar to what happened in the 30s, 1930s, the Great Depression, where the Federal Reserve literally did everything they could to save the markets and all the banks from exploding and blowing up and going bankrupt. And what happened? They owed Treasury a ton of money. Who had to pay that? The taxpayer. Where at that point they had to increase tax rates to an insane amount of level. I think tax rates went anywhere between like 50 to 70% of your income was going pretty much towards the taxes because they had to pay Treasury back. So the Federal Reserve doesn't have an unlimited money printer like people think. This falls ultimately back into the taxpayer, right? So the taxpayer ends up being responsible for that, which is you and I. It's kind of messed up what the Federal Reserve does. Bails out these big banks and they get into trouble in the first place, and then it falls into the taxpayer's responsibility to fix it. Nothing has been fixed. They've literally done the same thing over and over for the past 100 years. And the system hasn't changed whatsoever. I mean, how can you expect anything different to happen if the same system keeps repeating over and over again? So here is the interesting stuff. So the derivative markets, right? Right now, and then this is literally held, the major derivative players are literally a handful of banks, right? So is 203 trillion in derivatives held by Goldman Sachs, JP Morgan, Bank of America, and Citibank. They literally are the big players in the derivative markets, right? Which makes sense why the market is all-time high, right? Because it's all being stimulated by these so-called hidden derivatives, right? Which are usually the players in these markets are big institutions, corporations that are well-known, financial institutions, hedge funds, and so forth and so on, play in these large markets, even government entities and so forth. So $203 trillion in derivatives, right? The interesting about these, so for example, swaps, such as these are underlying common denominators for many financial crises and shocks to the system, causing entities to fail or creating funding squeezes. These off-sheet debts are estimated to be at a staggering 97 trillion globally across all currencies and growing fast. Why do these things exist? Because they make money. The big banks or the market makers, right? What do the markets maker do? They make money in the spread. They find two interested parties. One wants to take one side, the other wants to take the other side, right? One's either long or one's either short. And pretty much these banks make the market for these instruments, for these vehicles, right? But it's a zero-sum game, right? Because on one side, someone's making money, but on the other side, someone is completely either getting obliterated or they're losing a lot of money. So what the hell is a derivative anyways, right? So this is basically the definition, and if it doesn't make sense, I completely understand, because they make these things so complex to make it difficult to understand that to certain extents. I mean, even looking back to like the mid-1990s, a lot of the corporations that were getting involved in these derivatives didn't even understand what they were buying, because they make them seemingly so complex, right? So a derivative is a financial contract in which the value is derived from the performance of underlying market factors, such as interest rates, currency exchanges, and commodities, credit, and equity prices. Equity prices are stocks, right? So derivatives transactions include a wide assortment of financial contracts, such as structured debt to obligations and deposits, swaps, futures, options, caps, floors, collars, forwards, and various combinations thereof. So you can think of a derivative as basically a piece of paper that says, hey, I'm betting that Apple stock is going to go up in price. If it doesn't, and it goes the other way around, it loses in value, you're holding a derivative that is pretty much not only worthless, but now you're in for the ride, right? Meaning you're probably gonna owe some money on that derivative, right? So basically a derivative is dependent on the underlying investment that is stated to be tied to. So that's pretty much what a derivative is. And then there's all many kinds of different derivatives. Options are one, right? An option is a derivative tied to a stock. If you buy an option call, you're saying that, for example, I buy an option call on NVIDIA, I'm saying, hey, NVIDIA is going to increase in price. If it doesn't, I lose all my money, right? So that's pretty much an example of a derivative. So these are some interesting scenarios that are going on, because this is kind of what caused the whole 08-07 issue. And it's interesting that the problem has never been fixed. It's just gotten worse and worse over the years, and there's been no regulatory intervention. They're still being traded over the counter, which means they're not, it's hard to trace them, right? Because they're being traded in secret for the most part. But here you can kind of see an example of when a lot of these went into negative value, right? Which is typically the case when things are just hitting the fan, right? In the economy, right? Like 2008, when Bear Stearns went bankrupt and suddenly no one wanted these things and they lost a ton of value. That's usually when these things typically explode. And then what's the solution? Federal Reserve prints a bunch of money, they drop interest rates, and they inject the money into the system. Guess who owes that money? The taxpayer, right? And no problem fixed, because they literally allow the same thing to occur over and over again. It's just absolutely amazing. But it kind of makes sense, right? Because these major banks pretty much own everything, right? They have a lot of political influence. A lot of these politicians, when they when they're running for office, so forth and so on, a lot of their contributors or sponsors are literally these banks. So I mean, there's kind of like a bias motive there, right? I mean, it's just like a really messed up system. So here, the crazy thing that I'm seeing here is basically that is literally 4 banks that pretty much are the primary institutions involved in these markets, right? And one being JP Morgan Chase, largest bank in the US, right? Citibank, Bank of America, Goldman Sachs, which I believe Morgan Stanley belongs to Goldman Sachs. Morgan Stanley is known to having a division in literally just derivatives, right? So let's see here. So this is a report from the Office of Controller of the Currencies. You can literally get this stuff online. But what I'm seeing here and what I wanted to kind of go into is the sketchiness of the derivative business and how large these markets are, right? So notional amounts of derivative contracts, and this is in millions of dollars, right? So total derivatives, that's a monstrous number, 208 trillion, 97 million, or 97, 208 trillion, 97 billion, $703 million in the derivative markets between pretty much just these 4 major banks, right? Wells Fargo is kind of in there, but it's actually they actually have less involvement in this than the 4 big major ones: JP Morgan, Goldman Sachs, Citi Bank, and Bank of America, right? So those are the big players in the market. But I found some interesting things here. And then here we go into the percentages over-the-counter contracts, which this is pretty much the sketchy market, right? The market where you go into and you don't want anyone to see your trades, and what's really going on is kind of a shady market, right? So over-the-counter market. Majority of these vehicles are traded in the over-the-counter market, so it's a lot harder to track these trades and what's actually going on. So forward here, so this is just basically valuations of these. But the thing is, when these things blow up, they really blow up. Like I said, it's a zero-sum game, right? You have someone either winning and then someone either losing, but who knows who's winning and who's losing, right? And it could be major institutions, hedge funds, pension funds, because interesting enough, pension funds are involved in this kind of stuff. You would think, dude, you're running someone's freaking livelihood. You would not want to be taking this kind of risk, right? Mutual funds and so forth, right? So a lot of big institutions are involved in some really sketchy investments that you would never even know about, because these banks create these derivatives that make it seem as if they're not as risky as they really are, because of the way they construct them, right? So it's some interesting stuff that they do to pretty much get away from regulation. So off balance sheet positions, literally this is untraceable. When it's off balance, it means that it's not recorded on the balance sheet of the companies, right? So here we have $15,848,000,000 of off balance sheet derivatives, and then who knows what's the real amount, right? Because again, they're off balance sheet, they're untraceable. Interesting things. So let me just get a little further down here. And this involves interest rate derivatives or interest rate swaps, currency swaps, all kinds of different derivatives, right? So just some big money going on here. So commercial bank savings and trust companies and derivatives, millions of dollars, gross total notional amounts of interest rates derivatives held for trading. So these are the big ones now. In 07-08, it was credit default swaps, which was correlated with mortgage-backed securities. Now there's a lot of speculation in the interest rate derivative markets, right? This could be big companies, big institutions speculating or hedging against interest rate risk, right? The interesting thing here is this is a zero-sum game, right? One side is winning, one side is losing. So what I'm seeing here is basically an increase in these derivatives, right? In interest rate derivatives, since like, and I mean, right here, we're only seeing back to third quarter 2021 up to the second quarter 2024, just basically increase in the total amount of these interest rate derivatives. All other derivatives are pretty much dwarfed by the amount of money going into interest rate derivatives. And what are interest rate derivatives? So basically, interest rate swaps, parties exchange interest rate payments on a notional principal amount. One party pays a fixed interest rate while the other pays a floating rate, right? The floating rate can be something like the Fed rate, because it changes, right? It fluctuates literally on a monthly basis to quarter basis. So some companies might want to hedge or protect themselves on issuing debt, right? On getting debt or issuing debt to accumulate capital for whatever the hell they're doing, right? So basically, they might transfer the risk of what if interest rates are higher in the future, and I might have to pay more money for that debt. So why don't I buy a interest rate derivative where I hedge my interest rate risk, and received a fixed rate on my debt, and then I transfer that risk of the interest rate to the other side that is buying that derivative, right? So that's pretty much what interest rate swaps are. So one party pays a fixed interest rate while the other party pays the floating rate. This can be used to hedge interest rate risk or speculate on interest rate movements. Interest rate swaps are agreements between two parties to exchange interest payments on a notional principal amount. One party pays a fixed interest rate while the other pays a floating rate. This can be used to hedge interest rate risk or speculate on interest rates. So if the party that takes the risk of the floating rate and those rates continues to go up, now that party is losing that money, right? Because the other side pretty much locked in that fixed rate. So now the other institution that takes the other side of the play is taking the risk of those rates going up. And when it comes to derivatives, when you're wrong, you are really wrong. These are things that, people have played around with and they've literally gone bankrupt, because typically these are like vehicles you're using margin, right? So you're not only using your capital, but you're using borrowed money, right? Kind of like a real estate investment, right? You buy a real estate property, you put some money down payment up front, right? You borrow money from the bank. So typically you're going to borrow the larger sum from the bank, and a certain percentage is your down payment. What if real estate prices decline dramatically, right? Now that loan you took, which is going to be quite large, right, on a mortgage, is going to devalue. It's not going to devalue, right? You're still going to owe that money that you borrowed, but if the value of the property goes down, now you're underwater. So derivatives literally work exactly the same. That's why I kind of like calling real estate derivatives, because investing in real estate technically is investing in a derivative. Is an interesting interesting way that I like to think about it. So here we have total gross notional amount of interest rate derivatives not held for trading. So these are the ones that the actual banks or holding companies are holding as actual hedging or speculating, right? And what is a holding company? A holding company is just basically a type of financial holding company that primarily deals with derivative securities. These companies are often involved in activities such as trading, hedging, and investing in derivatives. These can be your corporations, right? Your hedge funds, your institutions, your insurance companies. Like literally the world is the oyster with this kind of stuff. If we look back into history, Procter and Gamble has been involved in these. Dell, the computer manufacturer or hardware manufacturer for the computers, Dell has been involved in this. A lot of big corporations have been involved in these kinds of markets, right? And in the past, they've lost a ton of money doing so, because this is a zero-sum game, right? One side wins, one side gets wiped out pretty much. So all the derivatives are the major shift in difference from 07, 2008 is that in 07, 2008, the majority of the concentration of derivatives were in credit default swaps, whereas now is basically corporations and institutions either hedging against interest rate risk or speculating in the direction of interest rates. But here you can see the major discrepancy between the amount of interest rate swaps in comparison to all the other different kinds of derivatives. Pretty much majority of the derivatives out there in the market right now are interest rate swaps, meaning that someone's either speculating in the direction of interest rates or someone's hedging against interest rates. So interesting here, we got and then you can see this is the sketchiness of this market. A lot of the times the data is not even reported. Pretty much every other quarter, This data is not even reported because this is a secret market these big players play into, right? And they don't, it's not a lot of transparency. In reality, a lot of people have no clue what's going on in these markets other than these big institutions, right, that are trading or involved in them, and the market makers or the big banks. They make these markets for these big institutions to play in. So from the fourth quarter 2021, and this is in millions, so $14 billion in interest rate derivatives till up to today. It's currently up to like 23 billion, and that's notional principal amount. Over the counter secret market, over the counter derivative contracts covered by the regulatory capital rules. So here you can just kind of see the trading activity in these markets have just gone ballistic over the last, I don't know, decade or so forth. Kind of see the trading activity that led up to the crap show that happened in 07, 08, and still a lot of activity here. The difference between 08 and now is that in 08 it was credit derivatives, right? There was a bit more, there was more activity in the credit derivatives, which makes sense because it was back when the whole mania in the mortgage was going on, right? Mortgage-backed securities, and then you had all these interesting credit default swaps and so forth. But there's still a ton of activity in these markets, right? And these are the markets that when they blow up, they take the whole global economy with them, literally. They take everything down with them. Major government intervention has to go into play. And the interesting fact is that I noted earlier, Federal Reserve is literally broke. So unless they planning on just continuously borrowing money from Treasury, which the taxpayer has to pay. So from your pocket, which you might have to pay in taxes in the future. And then an example of this that I can think of, at least historically, is back in the 1930s when they had to have some major intervention like that and just literally throw the kitchen sink into the market to stop it from just declining. They borrowed so much from Treasury that they had to increase tax rates by a ridiculous amount, where it kind of made no sense to, hey, if I go work right now and 70% of my check is literally taxes, who the heck wants to work, right? So the Federal Reserve is kind of like backed in a corner right now, where if stuff hits the fan, they're not going to have the firepower they had in 2007 and 08 to jump in and really stimulate the markets, right? Yeah, we saw that in 2020, because 2020 COVID, the markets were falling off a cliff. They had to intervene and borrow crazy amounts of money from Treasury to save the market. And then what happened? Inflation, so forth. So the Federal Reserve is literally broke. They have their back against the corner. And if a situation were to occur like 07, 08 again, it can possibly be a Great Depression-like style economic depression. And considering that we're seeing issues or speculating in the market by these major institutions in the same vehicles that created the 2007, 2008 financial crisis, is interesting. The only difference is that now, instead of being credit derivatives, it's interest rate swaps. But at the end of the day, they're still derivatives, right? So here we have derivatives contracts by products. Credit derivatives are these yellow ones here, which you can kind of see. These were the ones that caused the 07, 08 issue. So you can kind of see that we're much higher in 2007, 2008, whereas now they're lower, right? The difference here is that option volume, total options and futures and forwards and interest rates, which are the total swaps, are equivalent, if not more, than back in 07, 08. So it's interesting to see that the same instruments that caused the crises in the past might potentially cause them again in the future. So I have no freaking clue, but this is some really sketchy stuff. Foreign exchange. So this is basically currency hedges, or so you got interest rate swaps, and then you have currency swaps. Currency swaps are basically the same thing. It's just derivatives for currency, right? So in currency swaps, you have party exchange principal amount in different currencies and agree to swap the interest payment on those amounts. This often is used for hedging, for foreign exchange risk, or to obtain financing in a different currency, involving the exchange of principal amounts in different currencies and the corresponding interest payments. This is often used to hedge foreign exchange risk or obtain financing in a different currency. So that's pretty much what currency swaps are. For example, to use in the current time frame example, the Bank of Japan has been talking about increasing rates. They kind of have to, seems like, because they're having inflation issues, right? So if they increase their rates, probability is the Japanese yen is going to appreciate. Not so good for their stock markets, right? So a lot of institutions might want to hedge against that, right? And how they would do that, hedging is just basically kind of like buying insurance against a scenario you really don't want to occur, right? So they would buy insurance, foreign or currency swaps against that potential scenario, and protect themselves from that, right? It's almost like an insurance plan that these things are used, and others use it for speculating, kind of like gambling, right? But this makes the gambling look like a safe thing to do, because this is crazy gambling. So this is the interesting. So it's majority of the derivatives right now in the market, so reported, because who the hell knows what is actually going on, because this is done, majority of it is done off balance sheet and over the counter, which is untraceable, and it's unreported, right? The only people, or the only ones that truly know what's going on, is the institutions involved in this, the major market makers like Chase, JP Morgan, Morgan Stanley, Goldman Sachs, Citibank, so forth, and these institutions are involved here in these markets. So majority of it is swaps, right? Swaps are what I was just mentioning, currency swaps, interest rate swaps. Those are the big the majority of the derivatives right now are it seems to be in those areas, right? Commodities, commodity swaps, interest rate swaps, and currency swaps. So either institutions protecting themselves from interest rates, or speculating on interest rates, protecting themselves from currency risk, or speculating in currency risk, or protecting themselves from changes in commodity prices, or speculating in the direction of commodity prices, right? Who would do that? For example, airlines, Nestle chocolate, right? Because they buy commodities in massive bulks for their manufacturing process or their operating processes, right? So these are the kind of institutions that play in these markets. But you can kind of see here the total swaps makes all the other derivatives, it dwarfs all the other derivatives in comparison. So you can kind of see the majority of the money is going into that area. So this is some crazy stuff. And this will all be amplified. And then a big percentage of these are going into equities, right? Stock market. So it just makes sense. I was thinking, like, man, in 2023, we had the somewhat of a small bank panic, right? With Silicon Bank going bust, and there was a bit of a panic in the banking sector. Federal Reserve jumped in quick as hell and pumped a ton of money into the banking system, right? Banks, on the other hand, what are they gonna do? They got all this extra money. They got an open Fed discount window that they can just borrow money for cheap as heck. They're just gonna pump it into the market, right? Because that ultimately affects all these other vehicles, right? So if the market goes down, there's going to be some implosion going on in the derivative markets, right? So Federal Reserve doesn't want that nastiness to happen, right? So they're going to do whatever they're going to have to do to prevent that from happening. But then, as I noted earlier, the Federal Reserve is literally bankrupt. Like they have their back against a corner, and they don't have the same firepower that they did in 07 and 08, where they could have just thrown the kitchen sink to save the market and stimulate, right? So this is looking like, and then in the back of my mind, I'm like, no way, a 1929, 1930 depression like economic situation can ever happen again. It's just in the back of my mind, that's what I at least thought, right? But now looking at this picture, the Fed is broke. They owe Treasury money unlike they have ever owed them before, which at the end of the day, who the Treasury gets the money from? The taxpayer. Us, right? It comes out of our pockets, out of our taxes, right? They don't just have a money printer that they can magically unlimitedly print money. No, the taxpayer at the end of the day has to pay that. Same as 07, 08, taxpayer had to pay for the bailout of these major banks doing the sketchiness that they were doing and making all that money. When thing blows up, Federal Reserve steps in, borrows a ton of money from Treasury, taxpayer ends up forking up the bill. Pretty messed up, but that's pretty much how it goes. Same thing happened in the 30s, right? Same scenario. So it would be so interesting if what happened almost nearly 100 years ago is literally just about to happen, and the same area of the markets that caused the 07, 08 crisis could possibly cause whatever the hell might happen in the future. When, I have no absolute clue. But looking at all the sketchiness in the derivative markets and how much money is in these markets, when literally there's so much money in these markets that if something negatively were to occur, it would affect the whole financial global economy. It would be like a freaking nuke literally going off all at once, which is nuts to even think about that. But yeah, you can see here equity, right? Equity derivatives are just derivatives that are tied to the equity markets, right? The stock market. Again, a derivative is not ownership of the actual underlying. Underlying can be the stock, right? It's basically a bet on the direction of that underlying. It's kind of like math, right? In math, you have derivatives that are derived from a certain formula. Same thing here, which that's why these things seem so complex. But in reality, if you break it down to that, a derivative is in a speculation or a hedge on the direction of some sort of investment, or speculation, whether that is a stock, a commodity, you name it, anything that pretty much trades can have a derivative tied to it, which is then influenced by the fluctuation of price of the underlying, which that derivative is tied to, almost like a benchmark. This is another thing that kind of stood out to me: precious metal contracts by maturity. And then this could have maybe something to do with the gold and silver prices being at all-time historical high. There's major derivatives in those markets at the moment, right? You can kind of see here, literally going back to the early 2000s, there was not much activity at all. And then suddenly after 2021, boom, crazy activity in the derivatives that are tied now to precious metals like gold and silver. Again, another example here, a derivative in precious metals, for example, gold, is affected by the changes of the price of that commodity, right? Gold. If gold goes up and the derivative holder is long the contract, he makes money. If that same derivative holder that is long that contract and the value of gold declines, they lose a ton of money. And then on the opposite side, because there's always two sides to these contracts, right? You have someone that's long, then you have someone that's short, betting on a decline, right? So the individual that's short or the institution, right? And the prices of gold have gone up so much, you don't want to be that guy, right? Because that means you just lost a hell of a ton of money. However, if the prices of gold or silver, for example, whatever contract that derivative is tied to, goes down in value, that individual that is short the contract makes money. But this is super interesting to kind of see the activity that is in the precious metals markets on the derivative side, which has a lot to do, in my opinion, with the craziness in the price of gold and silver right now, because there's a lot of activity in these markets, and the big movers of the market seem to be the derivative markets. This is the largest market in the world, and you got the big guys playing in these markets, right? Not your retail investor. You got the institutions that have hundreds of billions of dollars playing in these markets, and they can really impact the direction of these markets. So just some interesting things I'm seeing in the derivative markets themselves. And it seems a lot like the past, right? Where this leads to, I have no idea, but it's definitely an area of interest that I'm seeing. With that being said, thank you guys for listening. If you want to hear any more in the future, just stay tuned for any sequential videos that I make. And if you have any questions, hit me up. If this stuff doesn't make any sense, I completely get it. That's why they make it so complicated. So people have a hard time understanding these things. Even the institutions that buy these vehicles don't understand it most of the time. Kind of like in the mid 1990s, when a lot of them lost money and they had no idea what they were buying or selling because they didn't really understand what these vehicles were. So with that being said, thank you guys, and I'll catch you on the next one. Have a good one.